Meantime, the Japanese yen falling against the U.S. dollar today, trading close to a 34-year low. The country's finance minister defending the currency, saying that, quote, there are some speculative moves that do not reflect fundamentals when taking into account domestic and overseas economic as well as price developments. Still, with the yen down more than 7% just this year, our next guest says the best move for the Bank of Japan is to raise rates rather than intervene in the currency market. Jens Nordvig, founder and CEO of Exante, joins us now. Jens, always great to see you. Your name is so fitting for this conversation. I'm sure you get that all the time. But in terms of raising rates, that's really sort of a tricky thing for the BOJ, even if it seems like the easiest thing to do. I mean, to put that sort of squeeze on the economy when so many of its mortgages are tied to floating rates, that could really hurt.
Yeah, it's a tricky situation they're facing, right? Because they're saying that the yen is not in line with fundamentals, but actually you can see what's going on in the rest of the world, right? The dollar is strong, and now they managed to hold it for a week or two at this level. So I would actually argue that it's getting out of whack, right, because of this verbal intervention. So eventually they have to decide whether they put money on the table. In 2022, it cost them $60 billion to intervene for a couple of days, right? So it's not cheap to intervene. But if they don't intervene, I think we're going to break high on dollar yen. It's just going to follow the global dollar trend that we're seeing. And the better option would be to say, okay, finally, the Japanese economy is emerging from deflation, right? And they can actually move rates. They obviously move rates from slightly negative to zero in March. But really, the big step is to actually go into positive. And that probably would be the right move in the next couple of months, rather than spending lots of billions of dollars on intervention that's not going to have lots of long-term impact.
Jens, I'm not suggesting we're on the precipice of, but the weaker this gets, the yen, the more you're going to start hearing about, currency crisis and what they have to do. They're clearly in a pickle here. Raised rates are obviously hurting the economy. Let the yen continue to weaken. That hurts their citizenry, and it also obviously hurts the things they export in. It just becomes more expensive. Speak to that. At what point are people going to be saying, you know what, this weaker yen's a problem?
Yeah, I think on raising rates being a huge problem for the economy, like, we can debate that. Like, interest rates are zero, right? Bank lending is actually very strong in Japan. Bank lending is growing very strongly, better than most economies around the world, right? So we've seen economies around the world like stomach a little bit higher rates, probably better than most people thought. We have 5.5 in the U.S. and the economy is still kind of growing, right? So maybe the Japanese economy will be okay with 0.5% or 1%. So I think there's a fear of raising rates because they've obviously been in zero rate or lower environment for several decades now. But I think they need to break out of that psychology. I think the right move would be to get off zero in the next couple of months instead of spending like billions of dollars intervening for just a short-term effect.
If they did intervene, Jens, what would the line in the sand be for them? 155, 154?
Well,
I don't know.
they've been trying to hold it here just below 152 for 2 weeks. They've had some success talking about it and getting it to stick there, but eventually they'll have to back it up. And I think we will see volatility one way or the other. Either they come and intervene and we have, like, the big down up we typically see, or they let it go through 152, and that's going to generate some follow through, including probably the Chinese currency, where they seem to be watching it closely and also holding that at the moment. So important time right here.